The John Franklin real estate model is a great example of HiE's dynamic business models. In this demonstration, we will see how a basic model framework can transform your assumptions into complex forecasts. We begin the model architecture section on the Assumptions tab. This tab drives the entire model. From one tab, John Franklin will be able to easily view and adjust his assumptions. Ultimately, every input on the Assumptions tab will be reflected on the Annual Summary tab. The Annual Summary will be the final product to show investors. This page displays the results of John's strategy and will be formatted to be consistent with his written business plan. Looking back on the Assumptions tab, you can see we have 5 major assumption categories: market, acquisition and operating, and then capital and debt. But first, let's revisit John's forecast of the real estate market. Remember, an important element of John's strategy is buying at the bottom of the market over the next 3 years. While the market makes a 20% correction over the subsequent 3 years thereafter, the fund will operate the properties giving prevailing rent and vacancy rates. Then, when the market levels off, the properties are sold and the fund is liquidated. Under the market assumptions, we start with the current market price per unit. The index value then adjusts the median price per unit over time. For example, at the end of 2013, the index is 110. This means the median price will be 10% higher, or $264,000. To the right, we are able to adjust changes in the market fundamentals that will affect the operating success of the properties. Next, we have the acquisition assumptions. This is the primary driver for the Fixed Assets tab. Let's take a look. The Fixed Assets tab is the strategic core of John's real estate model. As John decides the timing of the fund's acquisition, construction, and disposition activity, this tab will adjust accordingly. One quick side note. While the timing of John's model calculates on a monthly basis, quarterly and annual summaries are incorporated on every tab. Also, notice the use of my grouping function. This allows for quick access to any line item during any specific time period. Next, we will take a quick glance at the operating metrics of the property and fund management. The operating assumptions are reflected on the Financial tab. For example, on this line, property taxes are the product of the assumed tax rate and portfolio value, whereas repairs and maintenance is the product of the assumed rate of repair and rental income. Various drivers can be used to forecast different operating expenses. Scrolling down, we can see the model also facilitates the movement of cash to ensure the fund always has enough just-in-case capital. Next, we examine the capital assumptions. With these parameters, John can restructure the company with great ease, therefore allowing him to efficiently negotiate with prospective investors. The Capital tab is responsible for maintaining the investor's cash flow. Based on the assumed formation, the Capital tab will calculate returns and then activate the distribution mechanism. The waterfall, or structure of distribution priorities, can be easily changed as well. Finally, John has connections with a local bank that is willing to extend the fund a line of credit. He can quickly adjust the fund's debt obligation and strategy to pay off the outstanding balance with these assumptions. On the Debt tab, John can monitor the financing activities of the fund. Here he can see when the fund obtained a loan upon acquisition of a property. Based on the assumed capital restrictions, the fund will pay off the debt as soon as possible. Before we conclude this model architecture section of the demo, let me point out a couple of areas we haven't focused on yet. First is the balance sheet. Assets are mainly driven by the Fixed Asset tab, which we've seen, but notice the depreciation balance. On this tab, depreciation is calculated on a GAAP basis for the balance sheet and tax basis for the fund's tax distributions at the end of each quarter. Now back to our balance sheet. We know the liability and equity line items are derived from the debt and capital tabs respectively. We've seen how the operating and market assumptions affect the income statement. So with both these financials, we can now properly evaluate the business plan utilizing the cash flow statement. So that's the basic framework of the model. Simple, yet we're able to draw so many conclusions. Be sure and watch the second part of this series where we put John's real estate predictions to the test.